Smart Money just repositioned a massive 226,741 short contracts this week, quietly setting a brutal liquidity trap on gold. While retail traders are aggressively buying this dip, institutional order flow is flashing a completely different, highly bearish warning sign. Let's break down exactly how this market is being engineered behind the scenes right before the algorithms trigger the next major move.
So let's start with this staggering reality check right here. 226,741. That is the exact number of net short contracts currently held by swap dealers, who are the true commercial heavyweights in this market. While the average retail trader is zooming in on their charts looking for any excuse to hit buy, the biggest players on the planet have built an absolute wall of short inventory. This massive accumulation completely shatters the current bullish bias and tells us a major distribution phase is actively unfolding right now.
And this is exactly where the massive disconnect happens. You see, most traders out there honestly believe gold is just resting before another parabolic moonshot, so they're eagerly stepping in to buy every minor pullback. But institutions, they're operating on a totally different playbook. They are systematically using all that incoming retail buying pressure as the exact liquidity they need to offload their own positions at a premium. Basically, retail is out there reading candlestick patterns, while institutions are actively managing liquidity.
The undeniable proof is sitting right inside the latest disaggregated commitment of traders report. Take a close look at the managed money category, which represents those large institutional speculators. They literally just piled on over 4,200 short contracts in a single week, while their long positions basically flatlined. When managed money shorts this aggressively and commercials blanket the upside, it is a massive red flag. Guys, they aren't guessing here. They're deploying billions to shape where this market goes next.
When we translate those raw numbers into actual market behavior, the trap becomes so obvious. The other reportables group, which often acts as a proxy for smaller, aggressive retail participants, absolutely bought the dip this week, adding over 3,700 long contracts. Meanwhile, swap dealers and managed money did the exact opposite, just eagerly absorbing all those retail longs. Heading into next week, any upside push is highly likely to be a synthetic trap perfectly designed to fill those institutional short orders. Now, seeing how this underlying order flow translates directly to price action clarifies everything. Looking at the 4-hour structure, gold is perfectly rejecting off a bearish fair value gap and a daily order block sitting between 4140 and 4180. In smart money concepts, we refer to these as premium arrays, which are essentially high-value institutional selling zones. Every single time price pushes up into this ceiling, it is not a breakout. It's an engineered opportunity for smart money to initiate their next downward cycle.
So, the logical question we need to ask is, where is smart money likely targeting next? Dropping down to the 1-hour structure gives us our primary draw on liquidity. Check out that highly visible, extremely vulnerable internal sell-side liquidity shelf resting right there at 4070. That level is an absolute magnet for institutional algorithms. Retail sees that flat bottom as rock-solid support and tucks their stop losses just below it. Institutions, however, look at those exact stop losses as the required liquidity to cover their massive short positions. That is our immediate downside objective.
But remember, institutional traps always require a macro catalyst to actually execute. And looking ahead, we have a massive economic lineup, specifically Tuesday's U.S. core CPI print and Wednesday's Fed chairman testimony. While retail traders tend to think the news creates the move, institutions actually use this high-impact data to execute pre-planned capital rotations. We fully expect these events to provide the exact volatility needed to violently sweep that downside liquidity. Let's map out exactly how this trap is likely to unfold chronologically. Monday is typically designed for low-volume accumulation, deliberately luring retail into false breakouts. Then comes Tuesday's CPI catalyst, where we are hunting for a classic Judas swing, meaning a rapid, engineered spike straight up into our 4140 premium zone, just to trick early breakout buyers. Once that trap snaps shut, Wednesday's Fed testimony provides the necessary structural displacement to aggressively reprice the market downwards. Aligning this heavy commercial short distribution, the upcoming macro volatility, and the internal order flow, our focus for the week becomes crystal clear. We are strictly looking to sell rallies. Instead of trying to catch a falling knife alongside the retail crowd, we are going to position ourselves right alongside the institutional capital rotation. All right, here is your precise execution playbook. Our prime entry zone sits right around 4140. The absolute key here is patience. You need to wait for that Tuesday CPI spike up into the premium fair value gap, and then strictly look for a lower time frame market structure shift
to confirm the reversal. Your stops belong completely clear of our invalidation level. If we get that clean bearish displacement, target 1 is the 4070 liquidity shelf. Target 2 is the 4-hour swing low at 4040, and our ultimate structural floor is all the way down at 3920. A clean daily candle body closing above the 4165 level completely invalidates this bearish setup and signals a shift back to institutional accumulation. Before we wrap this up, I want to leave you with a core power insight that should completely reframe how you view every single chart from this day forward. Retail traders react to price, but institutions react to liquidity. If you are only out there reading the candles, you're literally only seeing half the story. So stop looking at where the price is going and start looking for where the trapped money is hiding.
If you're ready to trade alongside the institutions and finally stop getting caught in these retail traps, make sure to subscribe and drop a comment below with your own gold forecast. To follow future trading opportunities and detailed market breakdowns, you can open your trading account using the link in the pinned comment. The table is officially set for a massive liquidity sweep this week, so the only question left is, whose liquidity will you be providing?